This is The Wealth Puzzle with Michael Mansfield from the Lind Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Michael provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is The Wealth Puzzle with Michael Mansfield.
Hey, everybody. Thanks for tuning in. I'm Mike Mansfield. I'm happy to be back. We'll say it's been a few weeks since I made a video. I haven't forgotten about you. I didn't fall off a cliff. I was just busy. I was out in Texas working with Tana and Owen, and I just don't have the equipment out there. I don't have my fancy microphones and stuff to be recording and making decent videos. So anyways, back in action. It's a busy week. School's kicking in. So got all the little people going to school this week. So we're going to be back at the videos. I did talk to Tana and Owen about getting involved in these videos. So you should start seeing their pretty faces here pretty quickly. But good golly, so much has happened in a few weeks. So much information, so much data, so much economic news, geopolitical things, fascinating stuff going on. Obviously, the stock market at the moment keeps hitting all-time highs. The administration keeps signing pieces of legislation. Last video, we discussed the one big beautiful bill, the benefits for a lot of you. I've already talked to many of you. A lot of our clients have come in. We've started using our tax software to kind of model the improvements of how their tax liability is looking with higher standard deductions, higher SALT cap deductions. There's a lot of things going on there. So that's fantastic. What else is going on? Let's see. I was reading the other day and I thought it was just so wild. So far, the federal government has collected over $200 billion of tariff money. And remember, this didn't even get going till, the end of the first quarter. And we've already collected that much. So at this rate, are we looking at bringing in, I don't even know what, $500-600 billion a year of tariff revenue based on the current tariff model? 2 months ago, June, the Federal Reserve brought in $27 billion surplus, more money than went out. That hasn't happened since 2005. What an incredible statistic. The International Monetary Fund, the IMF, I think that's the Mission Impossible people, but it's not. They just revised projections for the United States GDP up to 2.7% instead of, I think it was 2%, 2.1. Well, what the heck? I was told we were going into recession. I was told that everything was falling apart. So why would the IMF come out and revise our GDP for this year to look way more attractive? That's a positive. The CBO recently came out and said that, we might have miscalculated future debt or future growth. And so we think the cumulative deficit over the next decade will actually be at least $1 trillion less than we projected. Well, that's a positive. These things are all positives right now. This weekend, Friday rather, the president and the administration, they're meeting in Alaska with Putin. Will there be a conclusion to the Ukraine-Russia war? I don't know. We'll certainly find out, but that would be incredible. It would be nice to get some of this geopolitical stuff to quell down, just like it did with India and Pakistan, just like it did with a lot of the Middle East stuff. So these are big catalysts. In the last few videos I've made, I talked about the stock market, obviously the direction of it. The minimum target for this year in my mind is probably seeing the S&P 500 at least tease 6,700. And the way that we get there is the way that we're getting there. Deregulation, tax favorability, trade negotiations, earnings reports. All those things are kind of holding true. The deregulation piece of the puzzle, which ironically is probably one of the most subtle, biggest pieces of it, hasn't even really hit. We're just starting to probably see that manifest here in the third quarter. We'll probably see it rolling in the fourth quarter, and we're going to see it full swing next year. And then we get to the big boy in the room, which is the Federal Reserve, right? This has been a huge conversation, a huge debate is, will the Federal Reserve cut? Obviously, it's a tale of two cities. Jerome Powell keeps coming out saying why he doesn't want to cut. And so what happens last week? On Wednesday, Powell speaks and says, you know what? Everything's too strong. Labor market's too strong. Inflation's too hot. There's too much uncertainty with tariffs. We're just going to have to hold off. And then the next day, the head of the Bureau of Labor Statistics comes out and says, oh my gosh, guess what? We actually don't create any jobs here in the US. In fact, we're revising the last couple months by like 300 and some odd thousand jobs down. Now, this is the same human being that last year, if everyone recalls, we made some videos about this, revised the previous 12 months last year down 820,000 jobs. Like, these aren't mild misses. These are massive misses. I mean, incredibly massive. That prompted the administration to fire that individual, saying, you know, what the heck is going on here? Why is this data so askew? What's amazing, though, is that data came out the day after Powell spoke last week. And so everybody on earth said, oh my gosh, if Powell had had that information the day before of how much less jobs were created in the US, that would have been a huge catalyst to cut rates. And here we see it on the chart. So I know it's kind of hard to see these things. What we have are these blue bars here. So this is now looking at the September Fed rate meeting. And what it's saying here at the moment is there's a 92% chance, so this left bar, there's a 92% chance that the Feds will do a rate cut all of a sudden. I think that's small to see. If you come down to this one line here in the middle, and anybody can go onto this website, it's the cmegroup.com. You just look up the Fed Rate Watch tool. So here it says, 92% down here. But if I go back 1 month ago, it was 57%. That's a pretty dramatic increase. You even go to the current rate. So currently we're this blue right bar where it says 7.8%. That's where we are currently. So it's saying, hey, as of September, there's a 7% chance we stay the same. But a month ago, it was a 40% chance. So that's declined dramatically. You take it a step further, and you go to the October meeting. Well, gosh, there's a 60% chance we've done 2 rate cuts by then all of a sudden. You go to the December meeting, there's a 50% chance we've done 3 rate cuts. And let's go down to that line, that 3.5%, 3 rate cuts. I go to that line where it's 50%. A month ago, it was only 25%. So all the probabilities, all the weight is going towards these rate cuts are now coming, because all of the sudden, remember, the Fed has a dual mandate: maintain price stability and keep the labor market in check. Well, the labor market now, according to the Bureau of Labor Statistics, is softening. Where's it at? This is it. This is year over year price changes, or jobs created. But basically, in simplicity, you can just kind of see, the bar was a little thicker and a little fatter, a couple of years ago, and it's just slowly, even though it chops up and down, it's just slowly getting a little thinner here. That means that the labor market's softening. The Feds need to get that under control. They need to spur the economy a little bit. Inflation, here's year over year inflation. So inflation is still kind of sticky at the moment. Obviously, it came up dramatically here during the COVID time period. By 2022, it peaked out. It's fallen insanely here in the last 3 years. And it's just kind of hanging out in that low to mid 2% range, so just above their target. But on any shorter time frame, it's it's slowly, just here's 3 years, so just slowly softening. It kind of ticks up, ticks down, but every time it ticks down, it seems to find a little lower spot. So it's trending in the right direction, still a little sticky. The inflation report came out this morning, and it was actually good. Even though it showed that 2.7% number, there wasn't any measurable inflation in goods and services. Remember what the fear of the Feds was? That all of the tariffs were going to create a boatload of inflation in the cost of things. That could happen. It might happen. It hasn't happened. And so until that starts to happen, we're going to see what happens here with Mr. Fed. So in any case, what else do I got up here today? So it's the inflation report that came out, the dollar index, no big deal. So the reality is, barring some measurable event that we don't necessarily see coming, obviously mild concerned about the irony of the softening of the labor market. Because remember, We are data dependent. We like information. It is hard to make good informed decisions. I mean, honestly, this is why the president fired the head of the Bureau of Labor Statistics, is because you're putting out data. People rely on that data to make informed decisions, just like Jerome Powell used that data to decide not to cut rates last week. And now all of a sudden you say, actually, just kidding, none of this data is accurate at all. And so it's very hard to make those good decisions. So in any case, a lot going on. Things are busy. Rather optimistic. We're still kind of in the summer doldrums. We're still in kind of that gray trading period. Sometimes between May and October, markets can be more volatile, certainly in September and stuff like that. But ultimately, what is the goal? The goal is, we think that with deregulation, now some Fed rate cuts, this could lead to some positive catalysts, certainly coming in the fourth quarter, seeing kind of that higher leg up in the market. If we saw a true breakdown in the labor market, if we saw a dramatic increase in inflation, if geopolitical stuff heated up, obviously there's plenty of reasons why we can have problems. So not everything is rosy, but at the same token, there's enough good unemotional stuff to at least keep the market at bay, keep the market grinding higher. And we're excited about that for the moment. And so in any case, like I said, I'm happy to be back. If you got any questions, thoughts, concerns, reach out to the office, 805-500-7035. You can visit our main website, thelindgroup.com. And otherwise, I hope everyone has a great rest of their week.